Okay, this is more of risk governance. Corporate governance and risk management, they go hand in hand. Now, if your risk management is strong, but your corporate governance is not strong, then it doesn't make sense. Now, the question comes, what is corporate governance first? Corporate governance is nothing but the processes which you used in your company. Now, if the company just wrote all the processes and they're not using that processes in their daily life, then it is of no use. So, all the processes and practices of the business is called corporate governance. And the processes includes everyone, right from senior management, board of directors to the smallest on-ground workers. Now, why is corporate governance important? Now, corporate governance is important because of these companies. Have you heard any name out of these four? No? Okay. So, these are big companies which failed. So, Enron was a big energy company. It was working in oil and it did a big fraud. And it collapsed. So is WorldCom. WorldCom was a telecom company. This was also a telecom company. This was, I suppose, pharma. All these companies, they did fraud. Now, if you look, companies are run by board of directors and the shareholders are the owners. When shareholders are the owner, board of directors do not lose anything, only shareholder lose. And shareholders do not work on day-to-day operations of the company. Board of directors work on day-to-day operation of the company, or management, I will say senior management, work for day-to-day operations. Now, when senior management lie, they do fraud, then the complete company fail. And that's what happened with Enron. I will just take one example of Enron to tell you how fraud happened in Enron. So, Enron was an energy company, very well known. Even in India, it was working. And Enron had taken a lot of loan. And when you take loan on your balance sheets, let's say this is liability and assets, you have few covenants. What are the covenants? Covenants are nothing but restrictions by the bank or investors on a company. What are the restrictions? Restrictions are like that you should not take more than 50% of loan of your capital. So loan should not be 50% of the capital. This is one of the conditions. So Enron had certain conditions on it. And Enron lost huge amount in derivative trading. This is during 1990, the collapse of Soviet Union. Enron lost heavily. What Enron did is that Enron wanted to take more loan, but covenants were not allowing it to take loan. So Enron did contract with big banks like JP Morgan. What was the contract? The JP Morgan will purchase oil bonds from Enron, let's say at $100 per bond. And after 5 years, Enron will purchase back this bond from JP Morgan at 140. Now, what happened here is that Enron showed this sale of oil bonds as sale in revenue rather than loan. And it went on till 6-7 years. And in those years, Enron started giving dividends and lot of bonuses to its senior management. 2 days before the collapse of Enron, the CEO of Enron sold all its shares in the market and lied that everything is fine in the company. Just 2 days after, company collapsed. One of the biggest company in American history collapsed because of the fraud which was done by CEO. And that's exactly happened with all other companies. You can read it on Google. Because of these failures or because of these big scandal, there was a dire need to have a good corporate governance practices. After Enron, the act came into existence, which is called SOX. This act compelled the CFO and CEOs of the company to personally verify and certify the financial filings. And if they are wrong, criminal charges were put on CFOs and CEOs. And even after this act in 2008, just before collapse of Lehman, 1 day before, the CEO of Lehman Brothers says everything is fine in the company and you need not have to worry about it. How could he say that a day before collapse? Because CEO and CFO should only verify financial filings and they should not verify what they are saying to the media. They can lie to the media. Only they have to verify the financial filings and not the media filings. So even after this act, people are lying about the financials of the company. Same thing happened with Satyam. I hope you know. Satyam was an Indian software company.
Yes.
Ramalingam Raju. He took out 5,000 crore from the company and gave it to another company called Matthias, which is exactly opposite of Satyam. And these companies were infra companies who took who took infrastructure project of Hyderabad Metro This 5,000 crore rupees was given as a deposit for Matthias Infra. And then what happened is that someone went into court and this deposit was stuck in Matthias. Ramalingam Raju tried to purchase the Matthias firm back into Satyam, but the FIIs, foreign institutional investors, did not allow him to do so. So he wrote a letter saying that I did a financial fraud of 5,000 crore in Satyam, and Satyam collapsed the next day. This happens because the owners and the people who run the business are two different people, and the people who run the business, they sometimes are not ethical. Exactly, this happened in 2007 and 9. I just told you what happened in 2007 and 9. Basically, the people who were doing underwriting, what is underwriting? Finding out the value of house. They started giving any value to the house. A house which was sold last month at 2 million now got sold for 3 million. So next month it might get sold for 4 million. So give it a value of 4 million. So the underwriting standards went down. Oversight, there was no oversight on derivative products. SEC, Security Exchange Commission. In India, we have SEBI. In US, they had SEC. There were no rules from SEC or from Fed regarding the derivative oversight. And the complex structure products of derivative led to financial crisis of 2008, basically. Yes, we spoke about Basel Committee, right? BCBS, Basel Committee of Banking Supervision, which was formed in 1988, that was Basel 1, 2006 Basel 2, and Basel 3. They are still implementing. The last date I know is December 2022. Still, banks have not came to Basel 3 norms. They are in some of Europe and USA, but not all banks came to Basel 3 norms. Now, what are these Basel norms? I told you about Hertstedt Bank. After the collapse of Hertstedt Bank, international body was formed, which was known as Basel Committee on Banking Supervision. That body was formed in 27 countries, and the rules of Basel applies to all the banks. And the rules are on capital adequacy, focused on credit management. We will see about Basel 3 norms in FRM level 2. But these are banking regulation norms, which says that, okay, if you are giving loan of 100, you must have at least 10 as your equity capital. So these are one of the rules. Another rule says that the trading and banking should not be same. So employees of trading should be different and employees of banking should be different. Capital of banking should be different. Capital of trading should be different. Bank should keep liquidity of at least next 1 year. Bank should calculate its own VAR model. Bank should calculate its own VAR model. VAR, value of risk. There are different models to internal models to calculate VAR. If you cannot calculate your own model, the central bank of the country will calculate a model for you and you need to use that. Now, I would like to show you VAR model of Deutsche Bank, what they did. Let me see if I have it in my Excel sheet. Yeah. Can you see the Excel sheet? I'm not sure.
Yes, yes. Sure.
Yeah, yeah.
No, not now.
Not now. Okay. Now you can, right?
Yes.
Perfect. Now, this is of 2019. I have taken it from annual report of 2019. This blue line is VAR. Now, this gray line is actual income. And the blue line is buy and hold income. So basically, when you have portfolio, you categorize it into trading, buy and hold, and available for sale. Now, look at the breaches of VAR. This was one time the VAR got breached here. This was second time the VAR got breached. Both were in buy and hold, means long term. Now, look at 2020. This is March 2020. Look at the VAR breaches. 1, 2, 3, 4, 5. Here, 6. In 1 year, there was 6 VAR breaches in Deutsche Bank during 2020. Now, if the number of breaches is more than 3, you need to keep double the capital. You need to increase your VAR or your capital depending upon the VAR. But what Deutsche Bank did, Deutsche Bank requested the government of Germany to keep the period of March 1 to April 30 as an exceptional period. And any VAR breaches during those periods should not be considered while calculating the capital adequacy. And therefore, Deutsche Bank is still breathing. Otherwise, they had to increase the capital by 2x. Okay, let's see what are the guidelines of Basel III. Basel III speaks about Tier 1 capital. Tier 1 capital means just equity capital. Equity capital should be 4.5% of total risk-weighted assets. Now, what are risk-weighted assets? Let's say home loan, agriculture loan, education loan, business loan. Now, the Reserve Bank of India, central bank, gives weights to all these things. So for agriculture loan, it gives weight of, let's say, 0.10, that is 10%. For home loan, it gives weight of 0.5. These are just assumptions. Education 0.6, and for business loan, let's say 0.8. Now, this bank has given 100 crore to home loan, 50 crores to agriculture loan, 30 crores to education loan, and 300 crores to business loan. So you just multiply 0.5 with 100, you get 50 CR. 0.1 with 50, you get 5 CR. 0.6 with 30, you get 18 CR. And 0.8 into 300, you get 240 CR. So 240 plus 50 is 290, 295, 305, 313. I'm not sure about my calculation, but 313 CR. Now, risk-weighted assets is your 313 CR and not complete 300, 400, 480. The total loan given was 400, but risk-weighted loan was just 330. So your capital, equity capital, should be at least 4.5 of these 313 crores. So that was first condition. This is tier 1. You have tier 2 capital also, in which preference dividend comes, preference shares comes. You have tier 3 capital also, in which long-term loan comes, which is generally more than 10 years and all that. And their rate is different. But this is just an example. Liquidity coverage ratio, your leverage ratio. What is leverage ratio? Your tier 1 capital to total assets should be at least 3%. Your long-term loan, net stable funding ratio speaks about long-term loan. Should be at least again 3.5%. Now, this is more important. Microprudential overlay. It says that when the market or when the country is going in recession, the bank should increase its capital. Please understand this again. When the country is going in recession, bank should increase its capital. That is counter-cyclical capital buffer. Now, the same thing which I have told you, liquidity coverage, net stable funding, macro prudential outlay, what does it do? It compels to increase, it's not written here. Yeah, but always remember what macroprudential outlay does. It compels the bank to increase the capital when the country is in a recession, basically. Now, Dodd-Frank, naam suna hai? Dodd-Frank. Okay. After 2008, the crisis of 2008, US government came up with this act called as Dodd-Frank Act. These were two different people. I think those were senators. Now, this act was enacted in 2010 in order to bring financial stability, protect customers, and improve transparency. That did not happen. Okay. So first rule of Dodd-Frank Act was this Volcker rule, which speaks that banks should not work in proprietary trading. Basically, portfolio management, investment banking, insurance selling. These are all proprietary trading or trading on the client's behalf. Bank should not invest in hedge fund and private equity. Now the problem here, guys, please understand this. The income of bank comes, let's say bank keep deposit at 6% and give loan at 8%. If it is CASA, then let's say 3%, give loan at 8%. If you see, if bank only works as a bank, the profitability of bank will just be 1.5 to 2%. And bank will collapse if they just work at 2%. So unless bank works in all these things, the profitability of bank will never increase to 8 to 9%, which they are at right now. So even if there is this Volcker rule, I think in 2019, Trump, the President Trump of USA, changed this rule, and this rule is now only applicable for a bank whose market value is more than 250 billion. So only large cap bank need to follow this rule, not small cap bank. Again, Dodd-Frank speak about derivative regulation. In your annual report, you need to tell about all the derivative products which bank is trading in. And there should be a separate section about its value, profit and loss, and all off balance sheet items. These are the regulations of Dodd-Frank. Now, Dodd-Frank even speak about systematically important financial institutes, which are now called as too big to fail. In India also, you have some banks which are categorized as too big to fail. I think SBI is there, Axis, HDFC, and I'm not sure about ICICI and Kotak, but these three are 100% there. Means what? Government will not allow this bank to fail. And if you are under these too big to fail, there are strict regulations on you, more strict than current banks. Then you have Financial Protection Bureau. In India also you have, like if bank fails, you will get 5 lakhs, up to 5 lakhs in your deposits. So basically insurance. And enhanced regulatory oversight. The SEC has more teeth now to check about the risk taking ability of banks and all that. So these are the 5 main points of Dodd-Frank. Few more. Executive compensation. The compensation of executive should not be based on profits. So because the compensation of CEO is based on profit, he will take high risk, and which is very dangerous. So a compensation of CEOs, CFOs should not be based on profits. And if someone tells you that, okay, this XYZ company is doing fraud, he will get 10 to 30% of whatever the judiciary decides. Plus, his name will not be shared with common public, and he should be given police protection also. So these are whistleblower protections in Dodd-Frank Act. Any issues here? I do not think so, but if you have, please ask. Good. Now, we are done with Basel. Shit. I don't know what's happening today. Yeah. Corporate governance best practices. How the company should governance, or how the shareholders or board of directors should run their company. First of all, board should have independence. This is very important. Now, in any board of director, you will have 8 to 10 people. Now, the rule says that, okay, there must be finance expert, there must be risk expert, there must be at least 3 people who are outsiders. In risk management company, one person should be an outsider, not from the company. There should be diversity in the board, a diversity of gender, race, expertise, and background also. There should be different committees in the board, like audit committee, risk committee, compensation, and these committees should decide how much compensation should be given, how much risk should be taken, and all that. These are best practices, okay? I'm not saying that every company does this. The company should transparently tell to all its shareholders, or what you say, stakeholders, and it should disclose all the material important information. Shareholder rights and engagement. So shareholders should know all their rights, and the company should engage with them by providing all the information. Now, after Dodd-Frank, it is compulsory to give all the information in investor relations tab on your website. Any shareholder can ask for any information by mailing on the website, and within a stipulated period, they are supposed to receive that information. Now, that is for corporate governance. Now, let's look at best practices in risk management. First of all, there should be a framework for risk management. When I say framework, there should be a complete process which is written down, who should look at what basically done by senior management, which outlines the roles and responsibilities, clearly defined risk appetite, tolerance, and escalation processes. So if risk is not followed, where should you go, whom you should tell, all these things should be clearly defined. So if there is a good framework, it has been found that there is less failure of risks. Okay. Risk identification and assessment. There should be a risk committee which identify all the risk in the organization, and they should have good tools for risk identification. So all the company should invest in risk management tools like risk register, matrices, and scenario analysis. And they should decide on mitigation strategies, whether you should go for insurance, whether you should go for derivative products, whether you should get out of that risk, and all that. You should continuously improve your risk management process, and how you are going to improve it, you need to monitor it. Unless you monitor, you will not be able to improve on it. And you need to report it on a specific time. Let's say every 3 months, 6 months, and all that. And you should make it as a culture, and you should bring awareness in the company. Okay. Now, what are the responsibilities of board of directors in risk governance? Basically, risk advisory director should be an experienced person from an outside the firm. The risk advisory board should contain people who understand the risk factors. Those people who do not understand, only because he has a lot of influence in company, he should not come on board of directors. Please understand, these are the best principles. I'm not saying this happens in the company. Now, if you see, Neeta Ambani is on the risk management board of Reliance. I'm not saying that she is not competent. After so many years, she might have got it. But when she entered on the board, she was not competent by then. Now, risk advisory board should act as liaison between board of directors and senior management. So this board should constantly be in touch with all these things, or senior management and board, and they try to bring transparency in these people, and these people should know everything about risks, because that if risk management fail, the company might fail, and we have seen it. And you need to educate. So risk advisory board need to educate the board of directors regarding the importance of risk management, and which are the best practices used in governance and risk management. Okay. What are the responsibilities of board? They need to review, analyze, assess, and monitor. We have already seen this as risk management process. The same thing, only the board needs to do it. What need to review? They need to review financial statements, related party transactions. So all important things which are related to risk. And they need to incorporate best practices and industry standard. Very easy. I'm not going to spend much time on it. Okay. And another theory thing. Risk management committee, subset of board of directors. So if there are 10 board of directors, at least 4 and 5 should be on risk management committee. They should be able to independently monitor the risk management effort. They should maintain contact with internal and external auditors. This is very important. External auditors are the people who audit your company. Now, big names like PricewaterhouseCoopers, they are the auditors. And it has been found that the managers of these big companies, they do frauds. So if you say this PricewaterhouseCooper was auditor for Satyam, I think, and they could not find out that okay, 5,000 crore is not there in cash with Satyam. The judiciary system penalized PricewaterhouseCooper, but they penalized the employees and not the complete company. In the recent transaction, PricewaterhouseCooper was penalized in Europe, but they were penalized with fine, but they were not penalized by not allowing them to audit. So nowadays, the new act is coming, which is yet to get board's approval, saying that the auditors should also be criminally penalized if they knew the fraud is going on. And then only this fraud will be able to, or we will be able to reduce all these frauds. Supervise all the known risk in the firm that approves high level decisions. We have seen this. Compensation committee, we spoke about this, right? So the compensation of high level management should not be linked with the profits. Okay. Now, the relationship between risk appetite and business strategy. Always remember, high risk, everyone knows. High return. High risk, high return. So, business will always try to take high risk. And it's the role of risk management committee to not allow business to take high risk. The firm risk appetite should align with its business strategy. So, if some firms want to take 10% risk and they have kept the buffer for 10%, the business should not allow to take more than 10% risk. And many times it has been found out that a lot of employees do take unnecessary risk. We will come up with, when there are, when we see the case studies, we'll find almost 5 to 6 case studies in which the employees has taken excessive risk and it was not known to the board of directors. Risk limits are imposed on strategic goals to ensure risk tolerance. So basically, you need to put risk limit on every business vertical. So if you have 10 business vertical, you should give risk limit to all of them. Risk supervision hierarchy. Always remember, unless the senior management, board of directors, and CEO are serious about risk management, unless they are serious, risk will not be mitigated. The board sets the enterprise level risk appetite through risk committee. The chief risk officer is responsible for day-to-day risk supervision, and the CRO act as liaison between board and senior manager. So basically, you have risk committees. These risk committees will speak to CROs, and CRO will tell everything to senior management. What is that? CFO and CEO and board of directors. So he acts as a mediator between all risk committees and senior management and board of directors. This we have seen, there is always a tension between business and risk. There will always be a tension, but it's a duty of CRO and risk committee to approve and decline the activity that makes it the approved risk limits. Optimizing the risk appetite. How do you optimize the risk appetite? By deciding VAR limits, risk limits, stress testing. We have seen all those things, all those things. Okay, now limits should be designed to accommodate normal business activity and provide a margin of error. So it should not happen that because of the risk, the business is hampered so much that you are unable to do business altogether. So there should be a complete balance between the risk limit and your business activity. And there should be a small margin of error should be provided. Risk limit exceptions should be documented. I have shown you risk limit exception of Deutsche Bank. And it should be presented to risk committee for review. Their interdependence, so business, finance, risk management, and senior, they all are interdependent as a function of presence. Functional unit of risk. So senior manager, finance, risk, and business. So the hierarchical, basically. I'm not going in detail. This is very easy. Audit. Internal and external audit. There are two types of audits which needs to done. It needs to be done: internal audit and external audit. Now, internal audit is equally important as external audit because external audit looks for only materialistic things. Internal audit looks for all processes, small processes. So, a subcommittee of full board of directors should be responsible for audit committee. What is the main objective of audit committee? To ensure compliances with the processes. So what are all the processes? Accounting standard, internal control, regulatory response, requirement, everything. Are the employees of the company are following the processes or not? That is the main objective of internal audit committee. Review of internal and external audit reports, monitoring monitors the independence and performance of auditors. Yeah, that's the main job of audit company. So these are all jobs of audit company.